This is the luxury world. Get inspired with us today and tomorrow. In this video brought to you by Luxury World, the long-held perception of Rolex as the ultimate safe haven investment is being examined. For years, Rolex watches have been seen as tangible assets that defy the usual forces of the market, particularly during periods of economic uncertainty. This idea reached a peak after the pandemic, when models such as the Daytona and the green bezel Submariner surged to unprecedented heights, sometimes tripling in value. These extraordinary price jumps solidified the notion that Rolex represents a financial sanctuary, a luxury asset impervious to downturns. For those who have not yet subscribed to our channel, doing so will ensure access to upcoming insights and content that can further refine their watch investment strategies. Yet, markets driven by speculation inevitably confront reality. For 9 consecutive quarters, the secondary Rolex market has undergone a profound and sustained correction. Some analysts have even dubbed this period the Great Rolex Recession. Prices for flagship models across the Rolex spectrum have fallen by as much as 30 to 40% from their 2022 peaks, raising a fundamental question. How can an asset simultaneously be marketed as a haven and still experience such dramatic depreciation? The answer lies not in the intrinsic quality of Rolex timepieces, but in the speculative premium that often inflates their market value. When economic anxiety replaces the fear of missing out, this premium can vanish almost instantly, exposing the hidden financial risk. This is not a simple market fluctuation. The post-COVID speculative bubble has definitively collapsed. Central banks have raised interest rates, cryptocurrency markets have imploded, and the speculative capital that once fueled sky-high valuations has largely disappeared. Those who acquired watches at the height of the boom are now facing significant losses. This analysis is not financial advice. It is an examination of the mechanisms that drive Rolex pricing and the dynamics behind the collapse. Understanding why these price corrections occur requires a closer look at the structural design of the Rolex market, which functions as a two-tiered system intentionally engineered to favor the brand and its authorized dealers. It is not a conventional retail environment. Rather, it is a carefully constructed ecosystem designed to create a disconnect between the retail price and the watch's true market value. At the center of this strategy is manufactured scarcity. Despite the capability to produce an estimated 1 million watches annually, the demand for popular models consistently exceeds supply. This is not a production shortfall. It is a deliberate strategy to maintain exclusivity and protect brand prestige. The effectiveness of this approach was particularly evident in 2024, when Rolex reportedly reduced production slightly in response to a cooling global market, the first such adjustment since the 2008 financial crisis. By carefully managing supply, Rolex transforms a simple transaction into a pursuit defined by patience, strategy, and sometimes frustration. The rarer a watch is, the more coveted it becomes. Authorized dealers, operating within this scarcity framework, receive highly limited allocations of sought-after stainless steel models such as the Submariner, Daytona, and GMT Master. These allocations often arrive in single-digit quantities, rarely reaching showroom displays. Consequently, traditional first-come, first-served waiting lists have been replaced by discretionary interest lists, where allocation depends not on timing, but on a customer's relationship with the dealer. These relationships are usually established through prior purchases of high-margin items, including gold watches, diamond jewelry, or other products offered by the dealer. This practice, known as bundling, imposes a substantial financial barrier to access. Even showroom models are often for exhibition purposes only, serving as aspirational displays rather than inventory for sale. This reinforces the perception of scarcity and fuels consumer frustration, ultimately driving activity in the secondary or gray market. The gray market, far from being illicit, operates as the free market's response to artificially constrained supply. It provides the most transparent measure of a Rolex watch's true market value at any moment. Gray market inventory often originates from customers with strong dealer relationships who capitalize on the premium created by immediate availability. A subtle, sometimes unspoken, pipeline exists between some authorized dealers and gray market resellers, highlighting the system's complexity. The gray market price comprises 2 elements: the retail price set by Rolex and a speculative premium, effectively the cost of bypassing the dealer's controlled allocation. This premium is the most volatile and financially risky component of a Rolex's value. The system is designed to shift risk away from the manufacturer and dealer, placing it squarely on the end buyer. While authorized dealers sell their inventory without risk, consumers who pay a gray market premium assume full exposure to market fluctuations. Historical downturn reveals the fragility of this market structure. During the early 1990s recession, Rolex operated in a pre-hype world, where prices softened as luxury goods were sold to raise cash. The 2001 dot-com crash saw wealthy individuals begin channeling funds into tangible assets, including watches, marking the early stages of the Rolex as investment narrative. The 2008 global financial crisis, however, provided the ultimate test. While gold appreciated as a true haven, the secondary Rolex market experienced steep liquidity constraints. Dealers suddenly had inventory. Forum discussions confirmed that previously unattainable models became available, and the market temporarily froze. The 2020 COVID-induced bubble was a unique anomaly, driven by unprecedented government stimulus, near-zero interest rates, and speculative capital from crypto and meme stock markets. Prices for some models soared to 3 or 4 times retail value. When the bubble burst in 2022, the speculative component collapsed, central banks raised rates, and liquidity vanished, creating an immediate correction. Indices tracking the luxury watch market fell by over 32% from their peak, erasing years of gains for those who had purchased at the height of the frenzy. Several critical truths emerge from this analysis. First, purchasing a Rolex at a significant premium is not purely an acquisition of a watch, it is a speculative bet on market sentiment. The financial risk resides entirely in the collapse of this premium, not the underlying product. For instance, paying $32,000 for a steel Daytona with a retail price near $16,000 effectively represents a $16,000 gamble on enduring demand and hype. Second, modern Rolex demand is heavily fueled by a demographic viewing of these watches as speculative assets. Younger buyers, often enriched by tech or crypto, drive market volatility. When speculative capital dries up, as during the crypto winter, demand can vanish almost overnight. Third, liquidity is conditional. In booming markets, a Rolex can be easily converted to cash. In a recession, the market experiences the inverse. Supply increases as owners liquidate for cash, while demand diminishes as disposable income shrinks, creating a dangerous liquidity trap. Finally, a Rolex is not a safe haven currency like gold. Gold benefits from fear, rising in value during crises. Rolex, as a Veblen good, thrives on confidence, aspirational spending, and economic optimism. In downturns, the very forces that elevate their perceived value vanish. In conclusion, the Rolex market is engineered to transfer financial risk to the consumer, and the safe haven narrative is largely a myth. Investments based on short-term market premiums can lead to significant losses. The true value of a Rolex lies in its craftsmanship, design, heritage, and the personal satisfaction it provides. Any appreciation in value over the long term should be regarded as a welcome bonus rather than a guaranteed outcome. The evidence is clear. Expecting a modern Rolex to serve as a shield against recession ignores historical lessons. The gray market premium reflects speculative enthusiasm more than intrinsic stability. Ultimately, the crown does not provide shelter from economic turbulence. It represents a status symbol and a complex interplay of scarcity, hype, and market psychology. What is the perspective on the gray market premium? Is it simply the cost of bypassing the dealer's line, or does it signify a permanently distorted and manipulated system? Share thoughts in the comments below and continue following Luxury World for deeper analysis of the luxury watch market.